And then we have the income statement accounts. On the income statement, you have most basically income and expenses. Now, if you're a small business, you might not have much going on in the balance sheet. You might basically have a checking account and basically some assets, some fixed assets possibly, and then your equity account. And then the income statement is where the action happens. And on the income statement, oftentimes you might not have that many income accounts because you do one thing to generate income. If you're a landscaper, you might just call it landscaping income, right? You might, if you sell stuff, you might just call it sales, right? If you're a restaurant, you might just call it restaurant income, service income, one basically income account. Or you could have multiple income accounts, but what you don't want to do typically is have a separate income account for every customer. That's usually not good because it's going to make a really long income statement. And if you track your income with income forms, you should be able to get that added detail using sub-ledger accounts, using sub-accounts or sub-ledger reports. You also might have a tendency to want to break out an income account by item. Every inventory item you sell and service item having another income account for, which again, you don't typically want to do because that would be too tedious on the income statement, but instead summarize the income statement accounts and then have sub-ledger accounts breaking out the income by what you sell as well as who you sell it to. So this one has fairly many income accounts, more than possibly normally would be the case. And then we have cost of goods sold, which would only be an account that would be used if you actually sell inventory. So if you don't sell inventory, you're not going to have cost of goods sold because it represents the selling of the expense related to the consumption of the inventory in order to generate revenue. And if you do sell inventory, you have to think about, are you on a perpetual inventory system or not? And that will be more or less complicated. We'll talk more about that as we go. Most of the time, the most flexibility we're going to be dealing with any type of business, small to large, is on the expense side of things, because that's where the largest number of accounts typically are. And that's where you have the most variant and most decision-making potential in terms of how you're going to treat the expenses. And your general idea with the expenses, if I go to the income statement over here, is going to be, do I want to have more expense categories, which is going to give me more detail, but it leads to a longer, more complex financial statement? Or do I want to have less expense categories, grouping things together, giving me less detail, but making the data input easier and the report simpler to read? If we add more detail, we have the added possibility of adding sub-accounts. So the sub-accounts, as you can see, is going to give me another little drop down over here. So for example, here's all of my expenses. All of these are categorized under expense categories, this triangle being constructed by category of expense. And then you've got these arrows that we constructed by making a subcategory so that it has its own little subcategory, so that I could make a summarized report, which would collapse these together into one account, but also give a more detailed report to break them out into more detail. These sub-accounts give us a little bit more detail for us to kind of format our financial statements in an order that we might want to do. Because note, if we don't use account numbers, which oftentimes people don't do because you can easily mess up your account numbers, then it's going to be ordered within category in alphabetical order as the default, at least. So you can see within expenses, it's then ordered within alphabetical order. And that could be kind of annoying because that might not want to be the order that you want. You might want to have some accounts that are next to each other because they are related, for example, such as fuel being related to maybe car repairs and whatnot. So you might want to have a subcategory making a parent of automobiles and then have everything related to the automobile as a subcategory, allowing you to order your accounts a little bit more simply, as well as have the capacity to expand the report and contrast the report. Now you have to be careful with sub-accounts. Some people love sub-accounts and their report is just, they got sub-accounts all over the place and they add almost way too much detail, right? And then other people, they don't add enough detail and they don't have enough categorization. They might be losing some decision-making capacity because they haven't broken out the information into enough detail. So that's really where a lot of the play is in terms of how you can report this. Now, notice QuickBooks will often give you a lot of like sub-accounts in the default breakout of their chart of accounts, possibly more than I think I might use personally. So then again, your question will be, do I want to use QuickBooks default subcategory method, or do I want to basically adjust that to do my own thing? So usually what you're going to do most of the time for small businesses is you might connect to the bank, and then most of your expenses, if you can pay them electronically, you might be able to use the bank feeds to record the transactions to the financial statements, which means they're going to be a decrease to the checking account, and the other side will typically be some type of expense. And then the question is, when I first set up my books, do I want to just use the default categorizations and try to find an expense category that has been given to me by default and just use their default categories as I record transactions into the chart of accounts? If I can't find an expense that I like, maybe I can find one that's similar and adjust it, edit it, and change the name. Or I could remove or delete or make inactive all of the expense categories that they gave me, and then I can make my own custom expense categories that I think are most appropriate as I enter the transactions with the bank feeds, which means that cash will go down and the other side of the transaction will most likely often be going to an expense, and then build my own, chart of accounts as we go, making it more customized and possibly more cleaner from the start, right? So if you use QuickBooks chart of accounts, you're going to have way more accounts than you probably will use. If you do your own accounts, then you'll create just the accounts that you need. If you use QuickBooks accounts and you end up with way more accounts than you actually use, then you might say, within a few months after I have recorded the transactions, I'm going to go back in here and delete the accounts that I'm not using, right, and remove them, and possibly remove the sub accounts if I'm not using, the parent account. Now I have one account in there.